Thank you, board members. That moves us into agenda item 12. This is our monthly budget report. And Scott, Deputy Superintendent of Operations, Scott Jones, we will turn the mic over to you. We're going to take a few minutes. This is like the fourth time we've taken a few minutes, but we got to get these microphones working so the public can hear. So Scott, we'll get you set up. We'll just take a second. Board members, please don't go far so that we can jump right back in when we get this addressed. Board members, I believe we're back on. So let's go ahead and get started again. We're, as a reminder, back with agenda item 12, monthly budget report. We've got Deputy Superintendent of Operations, Scott Jones. Please.
Chair Hymas, Deputy Superintendent of Operations Scott Jones, board members, and the public. The USBE is financially sound. We're able to meet all of our known commitments and obligations, but due to the government shutdown, I do need to caveat our conditions. Pretty much across all the federal grants, and I'm going to say this slowly because I anticipate the media is listening and they can and will be used against me in there. So I'm just going to say that from a fiduciary standpoint, we can continue to meet payroll for our employees at least through the end of the state fiscal year, which is June 30th across pretty much all programs. With an additional caveat, though, with the child nutrition program for those staff, because the reimbursements to our LEAs are paid out of one pot of money, so to speak, and then the costs of, our staff are paid out of a different pot. And we have carry forward money from there. So as long as the federal government doesn't mess or take that carry forward money, we should be okay in CNP2. The rest of them, Title 1, 2, 3, and our awesome USB staff, love you guys. We're tracking, we're good. And, of course we would update you. So please don't worry about at least this fiscal year. And then, we'll always keep our eye on the federal fiscal. I am very concerned, though, about that other pot of money, the reimbursements for the child nutrition program. Should the government shutdown progress, we anticipate shortfalls in our ability to reimburse the LEAs for their claims on meals, right? And it goes up each month because we're also dependent upon revenue from the liquor tax, the state liquor tax, to help sustain or help run basically our child nutrition program. So we'll keep a close eye on that as well. Obviously, the sooner the federal government can come to terms and then reopen and, we get back on track, we should be fine. There was last month, Board Member Bogus had asked for specific questions, and now you have those questions, and we're still working on those, ma'am. But we'll be able to later on show, maybe next month or something, show how we can better inform the public on how to use this awesome tool that's in front of you right now. We have a high budget. It's very complex. And I always do try to make sure that you and the public are informed of any issues or concerns that we do have with it. But for the most part, given the caveats with the recent shutdown, that concludes my report on our budget, Chair Hyman. Subject to any questions or concerns.
I'm not seeing any lights. I appreciate the follow-up from last month's questions. Let's move on to agenda item 12.2, the discretionary funds report.
If you'll just pull the discretionary funds report, I won't spend too much time on this. Obviously, we did spend time on it with the recommendations coming out of the Finance Committee. So subject to any questions or concerns with it, we can proceed to the economic update at your direction. That's okay if they don't pull it up. I just want to make sure that too, but we'll make sure it's updated based on the earlier actions taken by the board. So nothing significant to report on this at this time, subject to any questions or concerns, of course. So this is what you actioned earlier today.
Thank you. Perfect. We've got one question from Vice Chair Wood.
Okay.
On those motions that were made today, you said some of those may require legislative action. So is that a report you'll bring back to us?
Yes.
To say, and which ones, yep, we're good to go on those. Some of them we may have to wait then until,
Right.
is it March, like the end of the session?
Well, so what we'll do, right, is we'll capture your motions, and then we will identify, depending on what, Deborah articulated, and I'm saying this through the chair, is just that, right? We'll say, yes, this will take legislative action, and what that action needs to be, like, i.e., repurpose the money from this current line item to another one, or et cetera. Yes, we'll lay all that out, because would be, they've been considered as, and I agree with Board Member Bogus, there's no such thing as a technical change, but that's what they'll call it, right? They'll call it a technical change or move it, and we'll request that accordingly, and you'll have time to review those and to before the session starts, actually, with the proposal. Then, a lot of that realignment takes place, I don't know, maybe the third week? Yeah, about the third week in the legislative session, so.
One more question, Chair. Is that we ended up making a motion, right, to approve last session where we went through and said, yes, we want these things
Yes.
moved?
Yes. Yeah.
Okay.
So, and that process will likely happen again. Meaning that, the LFAs will make their proposals, and then, we'll be able to take that and maybe in one of your weekly meetings, or, just always depending on the timing, we would bring those to you, and so you could, do what you did last year, make motions
All
on
right,
them.
thank you so much.
Yes, ma'am. That concludes my report, Chair Hymas, unless there's other questions or concerns. At your direction, we can move to the economic update.
Let's go ahead and do that. Thank you. We'll move to,
Okay, sorry, Madam Chair.
move to item 12.3.
Good afternoon, Sam Uri, School Finance Director, and with me is
Ernesto Rodriguez, economist. Hi, good to see everybody again. How are you doing? So we're here to talk about, give you an economic update of things that have transpired since we last met. Quite a few things, especially this week, for example. So with that said, really good to see everybody. There's a lot of things going on. And so I'm going to start with monthly revenue snapshot. This is actually dated because there's been a new monthly revenue snapshot. This is from the Utah State Tax Commission. It is a summary of the TC23 report. So there's a new one that's come out for July. Then I focus or leverage the Gardner Institute comes out with a report, and this is also quite dated because there's just a new one that came out about a week and a half ago. So the September numbers, but not very far off from the June numbers and then the preliminary numbers before that. Next slide. So then the latest GDP report, this is the second quarter advanced estimate. These are dated as well because we just had a new number come out a couple weeks ago, solidifying what the previous reports had suggested, that the economy, after a brief hiccup in quarter number one, has responded. And this goes back to when we met last, I believe, in January, this iteration I had mentioned about the soft landing. Surprisingly, the media has not really focused so much on what seems the current or the past and the current administration, as well as the Federal Reserve, has achieved, which is that the economy, in lieu of all these hiccups that we've had, has continued to steadily grow, and at the same time, inflation has come down. Next slide. So these are the revenue highlights, and I would these are going to iterate sort of the same numbers, so I would really sort of we can move forward here. Next slide, because there's a July report that's out. Next slide, sorry. But these were just because the July numbers have come out, and they're just iterating the same thing. And that is the revenue collections have been up, and they've stabilized compared to the past few years. And so this is good in the sense that from a fiscal standpoint, in terms of revenues, everything has sort of steadied out. So next slide. And in that sense, if you look at the verbiage, what we're seeing is and sort of this last phrase here in the income tax fund caption, this growth was driven by robust growth in all the major income tax sources. Individual income tax grew 6.4% above what was expected to be a 4.4% projected growth rate. Next slide. And you're going to sort of you're going to see this in what's online for you to look at. These green arrows are indicating that growth has been above and beyond what was expected. Next slide. And this is just a trend showing that. And so it seems to be that we're recuperating, if you will, from the past few years. Again, in past presentation that reiterated how the economy has gone through, the national economy and then the regional economy here as well has gone through quite a few things. Next slide. And then this is going to be the July snapshot, which is the most recent one, iterating the same idea that fiscally, in terms of revenues, year-over-year increases or year-over-year numbers were more than the target rate. Next slide. And we see this across for the general and the income tax funds. Next slide. And so, again, same ideas here, above the projected range, and there was some stabilization compared to previous years. Next slide. And so, if you note, again, the verbiage is very positive and optimistic. In terms of the income tax fund, the growth of the source is largely supported by an underlying labor market, which has experienced steady growth in both years and a number of jobs, in both wages and a number of jobs over the last few years. And again, this is in line with really the previous slide I indicated, this notion of a soft landing. It just seems like the economy, both at the national level and regionally, locally, has been weathering the storm, if you will. Next slide. And so again, a lot of green arrows there, kind of positive, very optimistic in terms of what we have seen up to well, it'd be June, so up till a couple of months ago. And then the new monthly state revenue snapshot, we probably release shortly in October and November. Next slide. And so again, sort of these trends that we're seeing, these positive trends. Next slide. And so this was, and if you note in the slide there, I've indicated the January 2025. This is from our discussion last. And this was what I was iterating about, this notion of a soft landing. So the Federal Reserve has a dual mandate in price stability, dual mandate of price stability and employment. And what they have been trying to do is manage an economy that has weathered quite a few storms and also is dealing with high inflation at the time. And in that case, they have, as you see, from 2022 thereabouts to recently, that was going into the last quarter of 2024, we've had steady economic growth, which is what the Federal Reserve wants. In that sense, raising rates and at the same time being able to quell inflation, relatively speaking, has been their ultimate goal. And that's what that was from our presentation, this notion of a soft landing. Next slide. And so we see this hiccup in quarter one of 2025, and this was related to all of the uncertainty associated with the administration's stance on tariffs. And as you've noted, I think if you paid attention to news and media, this seems to change from day to day, week to week. And as a result, there was a lot of uncertainty in quarter number one. Quarter number two, on the other hand, we've seen sort of this not a relapse of sort, but we've gone back to what we were experiencing before that, which is the steady state of economic growth. And this was the advanced estimate. This was the first indicator from our second quarter report from the Bureau of Economic Analysis. Next slide. And so in this case, and this is just showing, it seems like the economy, if we look at this in the overall trend over the last couple of years, we're seeing this, we've reverted back to this positive trend, this steady trend. And iterating to us, at least it looks like this soft landing has been achieved. Next slide. And so these are numbers just from the Utah Economic Council. This is for your references. But you will know, and I'll just peruse through these real quickly, that whereas the national numbers seem to have, as the Economic Council releases updates, the national numbers have changed and have gone down a bit. Utah's numbers have either increased or have stayed sort of the same. Again, sort of relating to us that locally we're doing okay and we're stabilizing. Next slide. And these are just indicators from the June, and now there is a September report out as well. Next slide. And so this is just iterating what we had reported in that January 2025 presentation. Again, suggesting that as far as the Utah local economy compared to the national economy, we're doing relatively well. Next slide. And so I iterate this again, and it's startling considering that the media a few years ago was really concerned that could the soft landing be achieved, and it seems like we've achieved it, especially given recent second quarter estimates, which are giving us a better idea of where the economy stands. And I'll go through that in a minute, but I don't have it here because it was just released, with real GDP going up 3.8% year over year. And consumer spending was revised upward, which is the biggest component of the gross domestic product measure. So I'll iterate this again. It would seem that the economy is on more steady footing. And I think that's very impressive considering all the headwinds that the economy has gone through, both in the past and even now recently. I think has been iterated as Deputy Scott Jones mentioned, just the recent government shutdown and all the uncertainty associated with that. Next slide. And so this was the advanced estimate. We were at 3.0%, 3.3% in the second quarter. But then the next slide, next slide, sorry. Because this has been continuously updated, and this was the second estimate of GDP, which is 3.3%, so it was revised upward. And even this number, like I mentioned, has been revised upward again to 3.8% for the second quarter of second quarter of 2025. And so these numbers, again, come from the Bureau of Economic Analysis. They're very positive, very optimistic, suggesting that the economy has reverted back to that steady state of growth that we had seen previously. Next slide. And so that's just a report from BEA, and then they have a new one that is out now that you, if anybody wants me to follow up with them, I'd be more than happy to show them to you. But again, just suggesting that the economy has sort of stabilized itself and it's regained its footing after that hiccup, if you will, in quarter number 1. Next slide. And so what's important here, they have a economic symposium in Jackson Hole, Wyoming every year. Federal Reserve Chair Powell started to sort of open the door to this notion of they're starting to lower interest rates. And so with his comments, which are sort of scrutinized by many, though they indicated that inflation risks were tilted to the upside, and they indicated that tariff-related inflation pressures are clearly visible, downside risks to employment are rising. So you have this trade-off again in sort of simplest terms between inflation and employment. And by keeping rates high too long, that soft landing, you can, if the analogy holds that I previously mentioned in January, you're landing the plane, but now if you keep rates up too long, you're going to drive the plane into the ground. And so that is the concern now, is this rising unemployment and maybe in any form or any sort of layoff risk associated or in the economy. Next slide. And so as such, subsequently, the last Fed meeting, this was they lowered the Fed funds rate by 0.25%. This is the first reduction in 2025. This is the beginning of what we would call an easing cycle. And so interest rates, the Federal Reserve will cut in the near future. And as mentioned, they projected 2 more cuts for the rest of the year. They're still assessing the impacts of tariffs, but again, this trade-off between labor markets, employment, and inflation, and that's really on their radar now. So their projections are still inflation at 3.1%, and the real GDP was upgraded for the year from 1.6 versus 1.4, and the unemployment rate steady at relatively speaking, 4.5% compared to 4.3. And so, with that said, thank you very much. This was a recent visit to a USDB facility. Some of you were there. That was really neat. And so I really enjoyed myself. And I also want to thank my immediate supervisor, Director Sam Urey, and all of my FinOp colleagues. They make these presentations and all the questions that I ask them very possible. So thank you very much.
You, Nestor. One quick question.
Yeah.
Before we move on, and I'm not asking for your to be like, well, let me ask the question, but I'm not trying to do anything go against what I've learned. So Vice Chair Wood and I went to a meeting with Lieutenant Governor. We talked about some funding priorities that the board had addressed, and in that meeting, it was kind of like it's another tight year. And we understand, we've been doing this long enough, every year is a tight year, right? And I guess what I'm asking you, and again, not saying you approve or disapprove or you think higher or lower, the JLC has asked for 2% on top of the 4% for WPU. Now, we haven't addressed that, board members. Spoiler alert, I hope we address WPU today. In your estimate of the economy, is 2% a realistic number? Again, not saying we can go higher or lower, but is 2% a realistic? Again, not saying that the legislator will give it to us. I just am wondering where we're at from what you see.
So from what I see,
And Nestor, one more clarity. I know
Yeah.
you're answering the question. I'm interrupting you with my own question. Yeah, so when I say 2%, I just want to clarify, I'm saying 2% on top of what's already, yes, thank you.
Do you want? Okay. So in my estimation, we have to be really careful. We just this week alone, there's just so much uncertainty. Deputy Jones mentioned it earlier with funding. The government shut down. We're really unprecedented circumstances here. Before that, it was tariffs. And, we're seeing, so I think what we're seeing with revenues and what I showed you, I think is showing us, and again, I have to iterate, the economy nationally and regionally has gone, there have been so many different, whimsical events, if you will, go back 5-6 years. And so with that said, I think what we should aim for is just steady as she goes, go with what we've been doing. In that sense, the WPU went up 4% last year. Look towards that, pick and choose our spots if we can. But we have to be really careful because, case in point, we don't know what the impacts of this shutdown will be. And so, again, when in normal circumstances, you're really not looking over your shoulder saying, is the federal government operating or not operating? Does that make sense?
Yes, I appreciate that. Sam, you have a...
Yeah. So the inflationary measure is a 5-year rolling average of the core CPI, which is the consumer price index, less food and energy, tries to be somewhat less volatile than including food and energy. We don't have that September number yet, but the August number was 3.1. So it could even go down a little bit, maybe to 3.9%. We'll have to see what that is. It'll be close to 4%, but it may not be all the way to that 4%. To answer the question, it's difficult for us to say what the state's overall revenue picture will look like once we get to the legislative session, but it's all about legislative priorities, and we would expect that it would be difficult for the legislature to see a path towards much over the inflationary increase. That said, will there be revenue available? Possibly, and so.
And I don't mean to put you in an awkward spot.
The one-time funds, will be available again, and one point Nestor brought up today was that, if you look at it in some ways, that one-time money can be more valuable in that, we get to spend it on that year without further inflation as it goes up. But as Deputy Jones has mentioned, the cost of the WPU itself, with growth of different programs like the at-risk add-on and other things, has gone up, and so just getting to that 4% now costs $200 million in ongoing revenue. So I'm not here to say that JLC is crazy for asking for 2%. Certainly, we believe that at least that revenue will be available statewide, but we know that the legislature has many competing priorities to take care of. So,
Okay, thank you. And does that conclude your economic update? Okay.
A point to be made about, and iterating the point. I made this to Director Uri this morning, Nestor Rodriguez, economist. Think of this exactly. With inflation, one-time funds, because of inflation by definition, are more valuable now than they would be in the future. Something to consider for your priorities with regard to funding is just by the nature of inflation, is that one-time funds are more valuable. And so maybe something to keep in mind as you consider, of course, where your funding priorities will be. And with that said, yes, concludes my presentation. If there are any more questions, and also those numbers, we'll get them to you for the latest our CPI number that will be released in October. So we'll get that to you as soon as possible.
Okay. Thank you, both of you. Let's